we've been on the early end in terms of seeing inflation as higher and persistent, and therefore that the central banks would need to act more aggressively, and also that the result would be a slowing of the economy, recession now expected in 2023. We do think that the terminal rates have now begun to converge towards our view. And that would be probably more like 3% for the ECB, and 5%, maybe 5.5%, maybe 3.5%. For the Fed at 5.5% and the ECB at say 3.5%. I think that's important because the critical thing is that we get inflation under control. And therefore, we're entirely supportive of the central bank actions. We think it's important to signal to the markets that the determination is there. Obviously, there are risks attached to that, to the economy, to the financial markets. But the more the communication has really seeped into the marketplace, I think that that expectation is now almost fully priced in.
It's also a bit of a gift to the banks as well. What has Deutsche Bank done to monetize higher interest rates in both the US and in Europe?
Well, look, interestingly, it's a challenging ALM environment because you have to do what you can to anticipate the market environment, the actions of the central banks, obviously protect the balance sheet in terms of the interest rate risks that we run. In principle, we are well positioned for rising rates. Our business structure with very large deposit books is geared to benefit from the rising rate environment. And that's certainly what we're seeing in the performance. Again, corporate bank is up by 25%, in part helped by the rate environment, now both in euros and in dollars. And so it's something that we're obviously geared to do. Remember that it's after a period of very long negative or very low interest rates. So I see what we're going through more as a normalization. It is rapid, but to me, we're in a more normalized rate environment than the other way around.
How do you see the German economy now? Obviously, it's in the headlines a lot. We talk about the upcoming German recession. And previously, you've talked about a higher cost of risk. You've estimated that would add about 20 basis points in case of a full Russian cutoff of gas. We're kind of in that scenario now. So tell us how that's affecting your provisioning and sort of how you think things are going to unfold in the next few months.
So first of all, we do expect a recession now in Germany and in Europe, and in a ballpark about 2% next year, that is 2023 relative to 22. So the effect of the energy crisis and also interest rates, we do expect to be felt. We've obviously been preparing for that for a while, given it's been our sort of institutional view. We run very cautious loan books, so we focus on tight underwriting and managing within our risk appetites. As you say, we published a downside scenario in July of 1 billion, 20 basis points of potential loan losses in a crisis situation. At this point, we're seeing some of that come into our earnings, so in the third quarter, and as we expect in the fourth and into 2023. But what we're living at the moment is not as severe as our assessed stress view in the summer.